in listen-only mode.
Well, good afternoon, everybody, and welcome to this month's Grow Your Law Firm webinar on valuing your practice. Thanks again for all of our continuing subscribers to the webinar, and for any new people this morning or this afternoon who are listening in, welcome. So I just want to start off with a very quick poll just to get a bit of a feel to see who is actually listening in today. So if you could just answer that question for me. What best describes you? Sole practitioner, 1 to 3 principal firm, or 3 plus principal firm? That'll give us a bit of a feel for who's listening in, and I can make sure I tailor the webinar accordingly. So thank you very much. We've got 2/3 of our listeners today are in sole practitioner firms, with the bulk of the remaining listeners are in a 1 to 3 principal firm. And so what best describes you? Are you a principal or a solicitor, non-principal, or a CEO or a practice manager? Okay, so thanks for that. We've got a very good cross-section, but mainly principals listening in today, and equal numbers of non-principal solicitors and CEOs or practice managers. And last of all, that's those results. Last of all, just to get a little bit of a feel for whether or not you've listened in to any of our webinars in the past. So if you could just let me know, that'd be great. Usually we get a pretty good uptake of new listeners each time as our numbers keep growing. So thanks very much. We've got 60% of our listeners today have already participated in the past, and 40% are our first time webinar. So welcome, everybody. For those of you who haven't listened in the past and are just new, on our website, financiallywellorganised.com, you're able to access all of our past webinars as they've been recorded, just as this webinar today is being recorded, and the link will be emailed to you at the conclusion. So let's get into it. Just a little plug before I start. Available in October, my book, The Revenue Revolution for Law Firms, will be released. It's going into print in about a week's time, so please watch out for that one. And it'd be great if you got a copy of it. Everything that we cover off in these webinars is contained within that book. So what we look to do with our legal firm clients is to work with them to ensure they are financially well organised. And from that respect, we're going to be focusing once again today on the business plan for your practice. And the topic for today is on valuing your firm, and it's not so much around the principles of preparing a valuation on your firm, but more so around giving you a good understanding of what the drivers of value are in a practice. So, as a chartered accountant, I see 2 to 3 firms every week and look at their numbers, and in doing so, we get a pretty good picture of what works and what doesn't work in firms in terms of driving that value upwards. And what I've tried to do today is to put that into a simple format for you so that you've got some clear actions that you can take away from today and go and implement in your practices to be able to work on strategies that are designed to grow your practice. So what drives the value in your practice? First of all, there's 2 things. A firm's only ever going to be valued on these 2 factors. First of all, your profit and cash flow, and then the purchaser's appetite to risk. And if you want to drive your profit and cash, to increase your value, you've got to drive your profit and cash flow up. And the number that we look at there is the net profit after your principal salaries. And to drive value up, you also need to reduce your business risk. And from the perspective of a value in your practice, that is the risk of to a purchaser of the same profit be returning year in, year out. So the more likelihood that profit is going to be returned each year, the lower the business risk, the more that will be paid. The greater the profit, the lower the risk, the higher the value. So that's a fundamental principle for valuing really any business, and particularly small and medium-sized law firms. So the formula is simply what's the net profit after a principal's salaries, and multiply that via an earnings multiple. That gives you your business value. So we're going to look at today some of those factors that you can focus on to drive improvements in your net profit after your principal salaries, and then the flow-on effect of how that converts into improvement in cash flow, and as well as implementing strategies in your business that fundamentally improve your earnings multiple or reduce your business risk. So let's have a look at net profit. So that's the first place to start. The higher the net profit, the better the value. So first of all, in your practice, you've got your revenue, and that revenue is the total amount that you earn, your professional fees generally. I generally don't include recoveries of disbursements in this number because that's an in and an out. So really this is looking at the revenue you generate from your professional fees. Out of that, you take out your direct labour, and that's the labour that you pay for your fee earners, which includes your paralegals but excludes principal salaries. And if you'd like to refer back, I think specifically to one of my previous webinars around the efficiency factor, I go into a lot more detail around why this measure of gross profit is so important. And just to very quickly recap, that is the labour cost that you're paying for that you directly generate your revenue out of. So you need to be getting the right return on that labour cost, and you should be looking to drive that gross profit to be at least 75% or more of your revenue. So only 25% or less of your revenue should be being paid on your fee earner labour cost. You then pay out of that your overhead for premises, IT, indirect labour. So that's like your receptionists, practice managers, non-fee earner labour. That produces for you a net profit before principal salaries. You take your principal salaries out of that, and that then drives your net profit. So if you look at that in terms of your revenue that you generate, the net profit is often one of the smallest components that remain out of the revenue that you generate. So if you want to drive improvement in your value, you've got to drive an increase in this net profit figure. The higher the net profit, the greater the value after your principal salaries, that is. So first thing is you've got to think of the strategies around how do I do that. And the only real ways of doing that is reducing your overheads. You can't really reduce them significantly. Usually most small 1 to 3, 4 principal practices run on the smell of an oily rag. So there's usually not any sort of significant overhead reduction that can happen. Generally, where the biggest uptick for firms in driving improvements in net profit occurs is in their ability to generate revenue out of their direct labour cost. So really focusing on strategies to drive that gross profit will drive improvements in your overall value. Next is we're looking at the earnings multiple. So when you value a firm, the purchaser will look at what's the likelihood of that net profit that we've earned, so going back to net profit, recurring year in, year out, because that's the return that they get on their investment that they're paying in that firm. So if you're looking at a high risk firm, which is high risk meaning there's a much lower likelihood of that net profit recurring, generally the earnings multiple is going to be 1 to 2 times. So what I mean by an earnings multiple is the number of times that net profit a purchaser would buy. So if an earnings multiple is 1 times and the net profit is $50,000, then a purchaser might only pay $50,000 to buy that business. That would be the value of the firm. A medium risk firm would generally be at a 3 times earnings multiple, so 3 times that net profit, and a low risk firm would generally be at 4+ times. Not too many firms get sold around that 4+ times, and you've got to really be an exceptional firm to be doing that. Not impossible, but you've got to have implemented specific strategies in your business to drive that risk down. So I just want to get a little bit of a feel for your thoughts at this point in time on what you think your earnings multiple might be within your firm. So if you had to make that decision now, and you were looking at selling your practice, what would you see that the number of times net profit after your principal salaries that a purchaser might buy your practice for? So just pick a number there, and we'll just see how that's perceived with everybody that's listening in today. So just another 5 seconds, if you could just click on your response. Fantastic. So thank you very much. We'll close that. So looking at the people who are participating today, about 28% say one times, with the same number saying 3 times earnings multiple. And generally, I find that response to be quite normal, with a larger proportion feeling that 2 times their net profit after principal salaries would be their would be their value of their business. So let's just move on now to just getting a little bit more of the fundamentals of how this valuation methodology works, just so that we can lay the foundation for what the basis is of the activities that you need to drive in your practice to improve that business value. So business value is basically going to be your net tangible assets plus your goodwill. So just stick with me for a minute. I'll stop being an accountant in a minute and get through these numbers quickly. But your business is valued on this. It's net tangible assets plus your goodwill. Net tangible assets are those things like your cash, your work in progress, your debtors, unbilled disbursements, office furniture and equipment. Where your liabilities are things like your creditors, your BAS, PAYG, hire purchase and lease liabilities on your equipment, some levels of debt and so on. So your net tangible assets is basically looking at is what are the assets that I've got right there now, ignoring goodwill, what are the liabilities I've got to clear out of those assets, and the difference between the two is the net tangible assets. So why this is important is that when we work out what that value is to start with, we take off the net tangible assets to work out our goodwill. So here's just an example. If we've got a practice that's got a net profit after principal salaries of $150,000 and it has a 1 times earnings multiple, then that business value will be 150,000, 2 times is 300, 3 times is 450, 4 times is 600. What we then do is we take out the net tangible asset value, and that leaves us with a value of goodwill. So in the 1 times earning multiple, the net tangible assets are actually more than the business value from a valuation perspective, which means there's no goodwill. And then, as you can see, with the 2 times, the goodwill is 100,000 because it's the difference between 300,000 business value and net tangible assets of 200, and so on. So when you think of what when you're driving the improvement in your profitability in your firm, the outcome of that is that you are driving the value of goodwill, the value of the likelihood that, reducing the risk so that the likelihood that that net profit is going to return will drive an increase in the value, which produces a goodwill value for you. Critically important. So guys, really, as far as I'm concerned, now that's the end of the maths behind it. So let's now get into some of these activities that focus on how you drive up the profitability in your firm, and also reduce your business risk. The 2 key components of any valuation. So first of all, let's start with reducing business risk. There are 3 core activities or 3 core areas that you need to focus on in reducing your business risk. The first one is around delegated decision making. What this means is, and the outcome of this, is that it has a lower reliance on the owner, the principal of the firm, for making decisions. The more reliant on the principal of the firm for making decisions around the generation of that profitability, the lower or the higher the business risk, the lower the value. Simply because if you're a purchaser, you've got to actually take risk. You take on board the risk that if that owner's not there making those decisions, what will be the revenue and profitability that we generate? So you've got to think about how you go about creating a decision-making structure within your business that allows decision-making to be delegated, that maximises the opportunity for profitability to be generated without the reliance on the owner. Secondly, you've got to have very strong financial management systems, because the output of strong financial management systems is good cash flow. And fundamentally, you could be driving a really good profitable business, but if your debtors aren't paying and your WIP isn't being converted, there's an extra layer of risk if you're a purchaser, because it's not going to end up with the money in the bank that they'd expect. So strong financial management systems. We'll cover off a few of those in a moment around what I think you need to be focusing on. And thirdly, the main area of risk management is working out your strategies for automating as much as possible around how you're going to drive revenue growth in your practice. And the more automated and reliable your revenue growth strategy is in your practice, the more reliable will be your future revenues that you'll generate. Your future revenues will be. The lower the risk from a purchaser's perspective, the higher the value. So let's look at these in a little bit more detail. So let's start with delegated decision making. And from a delegated decision making perspective, I often call this your organisational responsibility chart for your business. But you've got to look at what the different roles are and who plays those roles in your business. So ultimately, the principals of the firm decide on what the vision is. And this is basically what our goals and targets are going to be. It might be our goals for the next 12 months, 12 months, 3 years, 10 years and beyond. The principals develop the vision around why this business exists and what you want to achieve out of it. But what they then do is they delegate the decision making around how we develop the strategy to achieve that vision to one person. And generally that should be the CEO or the managing principals. Now, in some instances, if you're a sole principal firm, you need to understand the difference between those two hats, so that you think, well, this is the goal setting, and then I've got to develop the strategy to get there. If you are a 2, 3 or more principal firm, this strategy development, in my view, should be created by one single person. And the reason being is that you need to have one person that's over everything in your business. It doesn't mean they do all the work, but it means they develop the strategy that gets signed off by the principals, because you only have one captain to a ship. That one captain takes ultimate responsibility for developing that strategy to chart the course to get you there. But then what happens on the way through is that you have a series of other people that are responsible in your business for activity implementation. If you're the only person in your practice and you're the principal, the CEO and the manager, then you've got to start looking at how you can leverage your time out of there in that manager area, the implementation area, so that you can get other people implementing and making decisions on a day-to-day basis. So that covers off a whole wide range of areas in your business, from how you manage your cost strategies in your business, how you collect your debtors, how you pay all your bills, from how you develop your product, from how you do your marketing, sales, production and delivery, and so on. So what you've got to do is create a structure in your business that gets more people in there at that activity implementation level, so that the business can operate without you being there making decisions on a daily basis. The better those decisions, the lower the business risk, the better the value. So next, looking at your financial management systems. Basically, this covers 3 areas. First of all, budgeting and reporting. If you're a purchaser and you can go into a firm and you can see that they have got strong financial systems around how they budget and how they report, with the numbers being accurate, actual versus budget, how they plan out their profit and cash flow forecast, you are going to have a lot more comfort that this practice is actually delivering on the results that you say you are delivering on. So first of all, that's one reason. Second of all, it is just good, sound business practice. Ensure that you've got accurate numbers that you're provided at least on a monthly basis that are comparing your actual versus budget. Secondly is having tight cost control so that expenses can't just get paid for out of the business, and that you are getting the right recovery out of your costs that you are paying in the business. So having tight cost controls will also ensure you maximise the amount of profitability that you generate out of your practice. And that also includes the recovery of the labour, of your direct labour cost. So it's managing getting good reporting and controls over the output of your fee earners. The better the output and the better the recovery of those fee earners and the management of those costs, the greater the profitability it will be. And thirdly, then giving strong billing and data collection systems in your business. The more quickly that your WIP build, it gets into debtors faster. The quicker it gets into debtors, the quicker it can get into the bank account. So good, strong cash flow is always as a result of very structured client engagement processes, very strong and structured billing systems and data collection systems. So those three key areas are three key focuses that you need to have in your business around having strong financial management systems to drive business value. So remembering when you're developing your cash flow strategies in your business, so you would have seen me say this a number of times, or heard me say this a number of times, and seen this statement a number of times for those who have participated in webinars before. And if you want to go to a previous webinar of mine that talks about strategies around driving cash flow improvement in your practice, there's a webinar there, financiallywellorganised.com, goes into this in a lot more detail. But what you've got to do is you've got to design your rules of engagements with your clients must be designed to reduce the period of time between signing a cost agreement and collecting the cash. I call that the cash gap. You really need to focus on strategies that are designed around the outcomes you want to get in your business. Don't worry about what the clients think. You need to design your strategies so you get your cash outcomes. Very important. And thirdly, and probably the most important and the most powerful strategy that you can implement in your business that's designed to improve the value is automating revenue growth strategies. So in your practice, you must be thinking about these three key components of what I call the revenue growth equation that you need to implement in your business to drive your revenue. So you need strategies that are focused on creating new clients and bringing new clients into your business. You need to focus on strategies that improve the matter frequency with your existing clients. I know that if you're, say, a family law firm, you've got then a challenge around, well, what are the other matters that we can open for a particular client? One way of doing that, some firms go into some estate planning for clients as well. So it can be opening up other areas of law. Or alternatively, if you're a general practice, don't like that term, or don't even like the term commercial practice. But if you're a practice, let's call it a practice that provides many different areas of law to your clients, you've got the opportunity for each and every single client to provide additional services to them. So what are the systems and processes and strategies you're going to develop and implement in your practice to increase the number of matters that you're opening up per client? And then lastly, you need to focus on strategies to drive that average fee up per matter. So you look at your number of clients. So it's your existing clients plus your new clients. What are the strategies around maintaining those numbers of clients and growing that number of clients, increasing the frequency by which matters are opened per client, and then also increasing the average fee per client. If you can drive strategies that continuously improve growth in those areas, your revenue is going to grow. And if you can create systems and processes in your business that automatically bring new clients in, increase matter frequency and increase average fee per matter, then that is going to be something that a purchaser is going to look at and say, well, I think there's a low risk here that this revenue is going to continue regardless of whether or not that principle remains. So what happens in most firms is you do what I call squeezing the orange. And that means you do a lot of the production and delivery work, which is just doing the work. And then on an ad hoc basis, you do some new revenue activities. You might attend an event or run a seminar or send an email out or visit somebody and have some lunch with them. But generally, what you're doing is you're trying to squeeze more and more profit out of just the function of doing the work, getting more productivity out of your people, or billing more to the clients on a particular matter. I call that squeezing the orange because eventually that orange is going to run out of juice. What I say to people to design a strong revenue strategy in your business, you need to be focusing on this strategy. You need to be understanding um, and developing strategies around what your product is and what product clients want. Developing strong marketing and sales strategies within your business. So marketing strategies are focused on getting that message out there, and sales strategies on how you win your work and how you finally do that. So focusing on strategies to win the work first of all, so that that work keeps coming in the door. Once you've won the work, you can then start doing the work, and that is how you produce and deliver that work to the clients and how you manage those relationships so they keep coming back. So you've got two distinct structures that you need to focus on in your practice around how you drive activities for work to come in as much of an automated fashion as you can, that doesn't necessarily rely you on the owner or the principal of the firm to have a conversation with a client to unlock it. So you can create specific product marketing and sales activities that are focused and designed around bringing work in. And then once it's in, you can do it. Do the work, do it efficiently, get it out the door, have great client service so that those clients keep coming back. When you focus on these two areas, the revenue growth formula as well as these revenue strategy areas, and combine them together, it comes you bring them together in what I call the revenue matrix. And what this does, it's designed to get you focused on specific strategies that produce specific outcomes for your revenue growth equation. So if you want to produce new clients, you need to develop marketing and sales activities to do that. You don't need to create new product to get new clients. You don't need to do the work better, so more efficiently to get new clients. You don't have to manage a relationship because you don't even have them as a client yet. It's purely marketing and sales activities. If you want to increase transaction frequency, you can provide more products to existing clients. Strong marketing strategies, strong sales strategies, but really focus on driving and managing the relationships you have with clients, because the better you manage those relationships, the more likely they are to come back and buy something from you again, and that increases your transaction frequency, or the frequency of matters in a year. You can also increase your average sale by focusing on product, marketing, sales, and client relationship management systems. But if you want to improve your margin, so excuse me, I'm going to go right back here when I talk about margin. This is your gross profit. So it's the relationship your direct labour has with the revenue that you generate, so the amount of revenue you generate out of your fee earners. One way of, if you want to focus on strategies to drive improvements in that margin, you can increase your sales, or you can do it more efficiently from the production and delivery area. So you can see that if you're just focusing on a strategy that's around squeezing the orange, which is around how you produce the work and do the work and deliver it, you've only got one way of driving your revenue, and that's by doing it more efficiently, and that's squeezing the orange. But if you take on board an overall revenue strategy that's focused on your product, marketing, sales, production and delivery, and client relationship management, you've got all of these other focuses and strategies that you can implement in your business that are going to maximize the opportunity to drive your revenue upwards. So let's get into a little bit more detail on that. Let's look at your product. So what strategies can you implement for your product? Look, product is basically what you sell. The challenge we have as professional services firms, I'm a professional services firm just like you're a professional services firm. You guys sell law, I sell accounting and management solutions and other financial solutions. So what I've got to do is I've got to identify what it is that I sell. And I understand that I can't be all things to all people. you guys as legal firms need to understand what it is that you sell. I was doing a strategic profit and cash flow session with a client last Friday, and we were exploring what their strategy was. And what we identified is that they were seen by their market as being a property law firm. And where they were developing their strategy was around providing non-property based revenue or services to their clients and potential clients. But it was something like 90% of their revenue was generated by property based transactions, be it conveyancing, subdivisions, leasing, whatever it might have been. So part of our strategy there was to get even more defined around what it is that they do. The more defined you are around what it is that you do, the clearer your clients will be around what you do. And the issue that you have around product is you've got to define it. You've got to produce content. People can't, you can write a letter of advice or you can produce a contract or an agreement. That's just a piece of paper. They don't get what that is. They're wanting a legal solution for you, whether or not that's to minimise risk or to achieve a certain legal outcome for them, or to buy something or to sell something. They only buy what they perceive that you can provide to them. So if you produce content for them and you're able to articulate what it is that you provide, then it's easier for them to buy it. And look, that comes in this day and age in three ways. You've got to write something about it, you can make a movie about it, or you can draw a picture about it, so that people can see. You get it out there on the internet. You show people what you do. You publish articles. You put it all on your website. The more of this you have, the easier it is for people to understand what your product is, and the easier you'll find it is to open those new files. So that's what product is, getting really clearly defined around what it is. And then if you want to open up a new area of law, you get defined around it so that, and produce information and content on it so that your market can understand that. Secondly, marketing. So the clip, just going back one more step on product. If you're a potential purchaser, and as you know, with legal firms these days, a purchaser doesn't necessarily have to be another a lawyer. It might be they're listed legal firms now, who the underlying owners of those firms aren't necessarily lawyers. The directors of those practices aren't necessarily always lawyers. You can run a multidisciplinary practice that doesn't have a lawyer as only lawyers as the principals. So the more defined the product is, the easier it is and the lower the risk is, because the purchaser knows exactly what they are buying. From a marketing perspective, marketing is really just about your messaging. Marketing's job is to do, it's to create inquiry. It's the link between, it's the link between your product and your sales. So marketing is getting the message out there to make people inquire around buying from you. So from a marketing perspective for a legal firm, it never ceases to amaze me the amount of money that gets spent on what I call brand awareness. And that's putting an ad up somewhere. You're just relying on a billboard for people, signs that are on buses. From a marketing perspective, the minute that you stop doing that sort of brand awareness, the awareness of you as a legal firm for a potential client ceases, because they can't see it anymore. So the key for professional services firms is to drive marketing activities for both new and prospective clients and also existing clients from a database. It's to grow the number of people that you're in contact with that increases the footprint. So from a legal firm's perspective, in that I specialise in legal firms, what I do is I focus on increasing my footprint throughout Australia and New Zealand. So I focus on activities to drive an increase in database, so I'm talking and communicating more regularly with more people. So first of all, the foundation is a database because that creates a footprint for who you can control, who gets your messaging. Secondly, it's understanding what brand awareness is versus direct response marketing. Direct response marketing is where you implement an activity that specifically drives an inquiry out of that activity that you can control, that you can, in a way, predict. So, for example, my webinars are a specific marketing tool. I have a specific database that I email. I can get a specific. I can predict the number of people that are likely to attend based on past webinars. So I can understand and have a and understand the likelihood if I continue doing this. This is what the likely inquiry rates are going to be. And you can do that in many ways via direct mail, web-based stuff. But anything that's not direct response that calls to action, that specific inquiry is brand awareness. That's your TV, that's your advertising in print, that's your billboards, that's your website. But from a marketing activity, you also got to run a multi-channel strategy. You've got to be running those activities with the same message over many different channels. So the channels might be, email. You might do some brand awareness advertising in a industry magazine, public relations, your website-based marketing, blogging. Webinars, so many different channels. But you target the same database, but do it over a multi-channel approach because you maximise the opportunity of your message resonating. So, from a professional services firm, marketing is around direct response marketing. The bigger your database, the cleaner your database, the better your database, the more you're educating and engaging your target database from a multi-channel approach, the more likely you'll continue to get an inquiry rate coming into your practice. From a purchaser's perspective, that is gold. From a sales perspective, it's then once you've got those inquiries, maximising the opportunity of converting that to revenue. So it's creating a process that reduces your conversion rates. So if that is the time from the number of inquiries that actually turn into a matter. So maximising the process. Never ceases to amaze me in firms where there are multi-solicitors or multi-number of fee earners, that often when an inquiry comes in, it goes to whatever solicitor is available to take that call. Well, the majority of professionals are technical people and they do not have any sales skills. So you should have your inquiries coming into under a specific process to specific people, so that sales process can be managed with an outcome that can be produced that maximises the revenue. You need to keep a list of every inquiry and work every one of those inquiries through to a final conclusion as to whether or not they're going to buy from you or not. And lastly, when you're engaging with your clients, you need to understand these three things. You need to understand what their objectives are. You need to understand when they measure, understand when they know they will achieve those objectives, and when and what the value of achieving those objectives is to them. Three critical things you need to ask every client prior to you engaging them. That will support you and assist you with improving your sales outcomes. Once again, Sales 101, there's a webinar on it, financiallywellorganised.com. Jump on there, grab it, listen to it. I've covered off all of those things. So once again, if you've got a good inquiry rate coming in and you've got a good conversion of those to a potential purchaser, they see that as a reduction in risk as well. When you look at the production and delivery side of your business, the key areas you've got to focus on are driving improvements in your file velocity, and that's the period of time from when a client is engaged to when that matter is concluded. The shorter the period that you can achieve, generally the more profitable that matter will be. But what it also does, it will create an energy by itself around with those clients and create advocates for you because you've done such a fantastic job. But also, if you reduce your file velocity, that means you're going to reduce that cash gap period of time between when the cost agreement signed and final cash is received, which is further going to improve your cash flow in your business, which can either be drawn out, reinvested, and so on. And also frees up capacity to do more work to generate more revenue. You also need to focus on these three core KPIs. Your productivity, that's your number of hours that your fee earners are actually charging to clients. It never ceases to amaze me where I see an expectation of only 4 hours in some firms that they expect their fee earners to charge, regardless of whether or not that's a solicitor or a paralegal. That means that almost half of their time in the week, almost just over 2.5 days, is spent not doing any client work. Well, what are they doing? So you've got to drive that productivity up or reduce the number of hours you've got available, which means sometimes reducing your fee earner numbers. You need to focus on your write-ons and write-offs. So recovering the maximum amount, generally all of it, of the time that's charged into WIP. And the result of an increase in productivity and a reduction in write-offs, it will drive up your average hourly rate. And what your average hourly rate is not the hourly rate that they're charging to clients, but it's the average hourly rate for the labour costs that you buy. So go and have a listen to my efficiency factor webinar, and I address that in some detail. Because every dollar of labour that you pay for, that and that's not charged, you're not generating revenue from it. So you've got to focus on how we're going to drive that average hourly rate up. And lastly, managing your relationships with clients. The better you manage your relationships with clients, the better, the more likelihood there will be that they will come back and buy more from you, and also that they'll refer you on to others. So to do that, you've got to structure in regular contact with your clients. They are low-hanging fruit. They've had good experiences. Make sure you do not ignore them. Create processes and systems that are designed to keep in regular contact and keep those clients engaged. Offer your clients unlimited telephone calls and emails for non-matter related. If you've got a matter open for a client, then you're going to bill them for when they're ringing you about it. But you want your clients to ring you about anything, because the more they're ringing you without the fear of a clock ticking and being charged for it, when it's on a non-matter related matter, that produces a sales opportunity for you. So do that. And also having a structured check-in with your clients so that you're keeping in touch, particularly with your best clients, regularly. The more you contact your clients, the more you talk to your clients, the more opportunities that will get produced for doing work. So I want to just put some numbers to this for you. So we've gone through a lot in this webinar today around what the drivers of value are, and what are those key areas you've got to focus on in your practice around reducing business risk and for driving improvements in your profit and cash flow to drive up value. So I just want to show you and put some numbers to this so that you can get a little bit of a better context as to what I'm talking about here. So this, what you can see on your screen here, is an assessment tool that I use when I go in and have a look at firms to see what the issues are that we need to address. So there's a whole pile of other analysis stuff that we do in here, but I'm just showing you how we sit down and plan profit and cash flow. So in this particular firm, going back to that revenue growth equation, this particular firm had 482 clients that they worked on in that year. They had many, many, many more than that are on the database, but they just didn't work with them all in a year. They worked with them 1.19 times each in that year on average, so that created 575 matters for the year at an average sale of 1.6 million, billing fees out of $920,000. They had direct labour cost of $325,000, which produced a gross profit of $595 or a gross profit margin of 65%. Overhead of $347, which then produced a net profit before principal salaries of $248,000. So in this particular firm, they then thought about the strategies that they needed to implement to drive improvements in that profitability. They implemented strategies around winning the work. So they focused on saying we needed to get a 5% increase in the number of clients that we work with during that year, be that existing clients or or new clients. So they only wanted to work with an additional 24 clients. They also focused on strategies to improve their transaction frequency by 10%. So going from an average of 1.19 times in a year to 1.31. So they developed strategies around cross-selling, upselling, new product, whatever that might have been. So all up, they increased their transaction numbers, so the number of matters worked on, only by 89, from 575 to 664. And what they then did is they focused on believing in the value that they provided, but also using some other sales processes to drive up the value that they were charging their clients on average per matter. And they have an increase there of 15%. So only going from 1,600 to 1,840, or an increase of $240. So with the combination of those three things, a small increase in the number of clients, which then when you increase your strategies around driving transaction frequency, that also then drives a cumulative increase in the number of matters, and then getting paid more for each of those matters would result in an increase in the revenue for that firm of just over 300,000, from 920 to 1,221. And assuming that they had no increase in their direct labour cost, they have an ability to increase, therefore, their gross profit from 595 to 896. But I'll just step over here to the right-hand side of that screen, because what we've got on this side is the capacity. It's with the labour that you've got employed and working in the practice, how much revenue could you possibly earn? So this particular firm had 6.5 fee earners, full-time equivalents. That gave them available hours that are being paid for but are able to be billed to clients of $10,868. They were out of those hours, only 49.1% was being charged, which gave them 5,340 at an average rate of 194, with an 8.6% write-off, produced their current revenue capacity. There's a slight adjustments here for rounding, around that $920,000. So if we looked at what capacity is available, and we increased our productivity numbers across the firm on average by, say, 17%, so that the average number of hours charged per fee earner were 5 hours per full-time equivalent day, that automatically increases the number of hours that could be charged to clients. You're already paying for them, but this could be charged to them. And when you've got a higher number of average hours charged, you often can have an increase in your average rate. That might be as a result of increasing your pricing via charge out rate increases, or it's getting better recovery out of your higher rate person. If you've got fee earners, say solicitors, professional people that are not hitting their productivity targets, but lower out per hour rate people are hitting their productivity targets, it can drive that average charge rate down. And lastly, if we could recover 100% of that time, what that tells me is that in this particular firm, they actually have capacity of $1.85 million. So they have more than enough. They've actually got 2 times the amount capacity of revenue that's being billed currently. So there might be actually an opportunity here to reduce our labour cost down, to reduce our number of full-time equivalents. So let's say we dropped a person and that was 50%, then it pulls back even further our current capacity, but still that is in excess of our target revenue number of 1.221. Overheads, as I said, they might be able to be squeezed a little bit via strategies to reduce. But by making small tweaks in your key drivers of your revenue around improving your number of clients, getting your clients to buy from you more regularly, and increasing your average sale, what you see is that the amount of revenue can grow. Your direct labour costs may be able to be reduced because you're running quite an inefficient labour cost there, because 35% of your revenue is going in labour costs, where you may have some excess, which means you can get that GP up, a little bit of saving there. So what it does, if those numbers are able to be achieved by focus, structure, and activity, It produces a profit originally of $248,000, and let's say you had $150,000 principal salary at an earnings multiple of 2, which was where we had the majority of people landing in our little poll earlier, what that would produce is a business value of $196,000. In this particular firm, you can see here WIP, unbilled disbursements and debtors were at $454,000, which is more than the business value, assuming there was at least $250,000 worth of other liabilities. So in this practice, there'd be no goodwill. But if we were able to maintain that earnings multiple at 2, but produce this extra profitability, then what it does, it produces an increase in that value of the business of $723,000. But if we've got strategies in place that drive improvements again in this earnings multiple up to 3, because we've delegated decision making, we've got strong financial management systems and strong revenue strategies for driving revenue through the door, so our earnings multiple increases, then on the same profitability, it has a significant increase there, you can see, an increase in value. So the next thing that we then have a look at is what strategies you need to be doing to driving down your lockup, or you're improving your cash flow by converting more out of WIP. So in this particular firm, they had opening WIP of $270,000, which is at 101 days. What this firm might want to do is get strategies down to get their WIP in around better billing, better engagement of clients, to get that down to 45 days. Their unbilled disbursements days are all right, and if they can improve their debtors collection systems, that might be via getting more money into trust at the front end, better engagement, more regular billing, and sticking to their billing policies under their cost agreement, they might get some debtor collection improvements so that their days go down to 45. What that does, out of a higher level of revenue, produces a lower amount of lockup with unbilled disbursements and debtors. Produces a great outcome. So when you're looking at how you're going to plan out increasing your your value for your firm, you've got to go back to these raw numbers. What have I got to do to drive revenue up? How am I going to create more dollar revenue in the practice? And by focusing on the revenue growth equation, you can do that. How am I going to get more productivity or recovery via revenue out of my labour costs? And then how am I going to manage my overhead so that I produce a greater profitability, minimise my business risk to get a better earnings multiple? How can I focus on strategies to drive improvements in my target days? Just to give that a little bit of a graphical explanation for you. This is that revenue growth equation we've just put through, but out of that extra revenue that was generated of $301,000, out of that there's only a small amount. You've got some recovery there of overhead, and you've only got a small amount of and a recovery there of direct costs. So effectively all of the revenue that you've generated drops straight down into the bottom line. You've produced additional cash flow by driving down your WIP and debtors days in excess of $400,000, so $463,000. Your profit's grown by $361,000. Most importantly, your business value's grown by over $1 million. So that's basically what you need to be looking at doing in starting at that high level and planning out what you're going to do to drive improvements in profitability and cash flow in your practice. So just to wrap up, the key that you need to be focusing on here is what are those key actions that drive improvements in profitability and reduce business risk. So really think about that and focus on what we need to be doing in that top area of revenue, number of clients, times transaction frequency, times average fee. Am I getting enough? Have I got too many people, or do I have enough? How do I get more efficiency out of the people that I've got working in the firm? And how do I then combine all of that to produce greater profitability? So as always, at the end of these sessions, these webinars, I'd like to offer to the first 15 to email me today at matt@fwo.net.au. First 15 to email me will get scheduled in a free 45-minute one-on-one profit and cash flow review and report valued at $950. Basically, we will just email you some core numbers that you can then slot into. We'll then slot into this assessment tool and talk about your practice and the stories that it's telling me, and then maybe talk about some things that you can be doing in your practice to drive improvements in profit and cash flow, and therefore in ultimate value. We'll then, just go back down here. Sorry for that. Then and then, so the first 15 to email me through, we'll get that. Also, keep an eye out. In October, I'll be launching my book, The Revenue Revolution for Law Firms, which gives you a very good insight around a lot of these strategies that you can implement and achieve very easily within your practice to get some amazing outcomes. My next FWO Growth Club is starting on the 11th of November. For those of you who are aware and those of you who aren't, this Growth Club focuses on 1 to 3 principal firms, where I bring up to 10 firms together throughout a 12-month period, where we work on strategies and implementing strategies in your practice to drive improvements in profitability and cash flow around all those areas we've talked about today. It commences with it commences with a one-on-one, in-depth, on-site assessment of your firm around profit and cash flow and strategy development around what you need to be doing to driving improvements in those profit and cash flow over the next 12 months. So if you're interested, please register now for my next Growth Club. There's only 3 spots that are remaining, so just drop me an email, matt@fwo.net.au, and we'll organise a time to catch up and talk about that. And please, if you have a moment, go to financiallywellorganised.com. Have a look at what we offer from our fixed price annual accounting service, which is a fixed price all-inclusive compliance service for legal firms. Join up our free FWO legal firm membership on the website, which provides you with a free bi-monthly legal firm magazine on practice management and other issues that are specifically tailored for the legal industry, as well as other free benefits such as unlimited telephone calls and emails to me about anything you'd like, no strings attached, and also for a bit more detail on the FWO Growth Club. So thank you very much for your participation today. Looking forward to our next our next Grow Your Law Firm webinar, which you can register now online at financiallywellorganised.com. And what we're going to be going into in that webinar is around fixing your practice. So strategies that you need to do from a current profit and cash flow perspective to really make some decisions around getting different outcomes in your practice. So thank you, and see you next month.